Thank you very much, Scott. Right, so let me give you a bit of a background on myself. I'm a financial economist by training, and for past 20 years, I've been working in banking, investment management, and now in insurance, leading strategic and digital transformation. And in that time, I have seen moving from branch banking to internet banking. I have seen insurers go from papers to digital, and investment management, which is turbocharged. I've seen traders trading daily instead of, and moving to HFTs, high frequency trading platforms. So it's been a journey of seeing everything turbocharged. And in the recent time, what I have seen, and which you have observed and Tanguy also referred to, is that digital innovation or the transformation has really speeded up in the last 3 years. For example, in 2019, the total spend across industry on digital transformation was 1 trillion. And at the end of 2020, up to 2021, it is expected to be 2 trillion. So that is doubling up, and it's in trillions. So what's happening today is that everybody is realizing that how much more speedier and easy to scale it is when you have adequate technology or are using technology. And there is no reason for such technology not to remain outside, because the cost of compute and implementing has become much lower. So with that in mind, I'm going to today talk about the specific case of large commercial insurance. Now, just to give you a bit of a background, So I'm going to talk about, in terms of how this will flow, is that I'm going to talk about, give you a bit of background of what we do in large commercial insurance. Then I'm going to talk about what are the technology challenges in the large commercial insurance, and then the opportunities from acceleration, emerging technologies that are shaping this large commercial environment, and then what can you take away from all this. So large commercial insurance, so overall insurance sector is a $5 trillion beast. And this $5 trillion beast is life, health, and P&C. The property and casualty insurance, which insures your physical assets, and also accidents, etc. Motor is the biggest part of it. It hasn't increased a lot in the last 20 years. It has actually been quite stable. And that is a problem for the insurance industry itself. Why? Because why it's happening is that when you do not take that insurance, you create what is called a protection gap, which is if some event were to happen, you are not protected by insurance industry, in which case you pay out of pocket or the government pays up. And this is especially the case with things like flood insurance. One of the interesting things that I found out in the flood insurance in the recent European floods is that how much better we are in managing flood risk in UK than European counterparts have been. For example, 90% of the large flood risks are covered in UK, whereas similar number for Germany is 40%. And Germany is a larger economy. So we are 3 trillion. So you can see that there is really a good emphasis through the flood risk management from government and also by insurers to make people aware that we are flood prone and therefore we should take flood risk covers. So that's something that is very interesting, but it is interesting in the area of cyber, it's interesting in other property damages, it's interesting in managing supply chains, that when a particular event occurs, are you covered for it or not? Today, the large commercial insurance, which manages the corporate and specialty risk part of it, which is 350 billion. Imagine world's property assets are trillions and trillions, of which only 350 billion is covered under insurance industry premia. It doesn't, so there's a difference between premia and sum assured. Sum assured is what you cover in terms of what you will pay up. And premia is the amount that you pay into the insurer. So in commercial business, what we are doing is we are offering protection to industries, to large corporates. We're offering protection to large institutions. These are against the risks of protecting your reputation against a particular class action suit, like Lemonade's instance was mentioned. We would offer such a cover. We offer covers against directors and officers of companies against any actions. We also offer worker compensation, supply chain, and political risks to our industry moving into another country. So these are large, chunky risks. And the size of these global corporations is so large that it requires anyone who is trying to underwrite risk or specifically provide cover for this risk to look at huge amount of data sets. So what's been happening in this really complex industry? In this really complex industry, there have been years and years of mergers and acquisitions, and companies are growing bigger. Companies like Chubb, AXA, Allianz, these are AIG, these are 4 big commercial insurance companies. They are growing bigger and bigger by mergers and acquisition. Commensurately, they are acquiring technology platforms from all of these acquisitions. The cost of integrating these technology platforms is so forbidding that the lot of effort is not being put into integrating these platforms because of the complexity of managing such complex integration. And then because the nature of the industry is such that the earnings are very, very volatile, the received logic is that the ROI on any technology spend is low. So what that does essentially is make people very conservative about spending money on technology. So every time you speak to senior leaders within the commercial insurance industry, they are marred by, last time I tried doing this, it didn't work out, so it ain't gonna work out this time as well. So it's the trauma that a lot of people carry, which really builds into the inertia that the industry had. And then what this does is it impacts the operational agility, and also the process efficiency is also impacted by these multiple set of technology estates that commercial insurers sit on it. And what is now happening is that with the pandemic, they have realized that social distancing meant that a broker cannot take his little suitcase and go visit all the other insurers who are going to take part in a large syndicate. So for example, we're covering a large infrastructure project, which might be building roads in a particular country, and you are insuring the risk for that. It will be multiple insurers who are going to co-insure that. And a broker will go around meeting these people. It's an efficient process, and it's a very relationship-driven process, but that's how it has been done. But with COVID, people couldn't travel. People couldn't sit down with each other, so they were forced to look at the digital option and came to realize that this is really a very efficient and a good way of scaling our business, which is why there was understanding within C-suites, within all of these large insurers, is this is an opportunity. It's not a threat, and it's not something which is deviating us from our core business of managing relationships and writing good risks. So that has really meant that a lot of commercial insurers are, interestingly, looking at many of these emerging technologies seriously, and also piloting and going into production with many of the technologies. Clearly, some of the major technologies, emerging technologies that we are looking at are, like Tanguy mentions, AI and ML, and then there's DLTs, distributed ledger technologies, which is blockchain. We also have a huge amount of appetite for and test for marine IoT and industrial IoT, where we are constantly receiving information through connected devices about a risk environment, say a factory fire, which you will have to pay as insured, you can actually give preventative advice through industrial IoT implanted into these factory units. So these are some of the emerging technologies that we are seeing a lot of applications within insurance. So some of the main ones I'll talk to you quickly, and then I'll take your questions because it's more interesting to get questions instead of talking at people. So I think that it might be more, I might be able to explain more if you were to ask me certain questions. So what's happening, say for example, I am a company A and you are covering offering me a DNO or a directors and officers insurance product as an insurer. The information about me, about my environment, which could potentially raise an issue of liability, a legal liability against my directors and officers can come from anywhere. I operate as a multinational, maybe in 50 to 60 countries, even hundreds. So there is multiplicity of events happening or activities that I'm conducting which may make me vulnerable to a particular type of action, legal action, of which the insurer covers me against. Insurer today is basing their information on snapshots. It's a hindsight-led model when I price a particular premium. Now, there is an emerging ecosystem where you can combine the client in the data and the existing data that you have into pricing models which are more accurate, which are imputing risks better. So artificial intelligence is helping in this a lot. Another thing that AI is, or rule-based engines, which are specifically NLP is helping us in is the submission. Every time you, as a corporate, say for example, large corporate like BP, British Petroleum, wants me to write a particular risk. When they send me information for me to assess the risk, it's sent in any of the various forms. They can send it digitally, they can be paper copies, and the information is vast. The submissions need to be looked at, put into rule-based engines, extract right kind of information, and then I need to price. So you see the volume of information that a commercial insurer uses to price the risk is massive, and the NLP applications today are using are actually automating this and extracting through the right level of information to go into the rule-based engine so that the pricing can be correct. And so that's really helping our underwriters who are manufacturing engineers to take right kind of decisions on what kind of cover we should be providing you, what kind of legal wording there should be against it, and how we should be able to provide you any risk engineering solutions or risk engineering advice to actually preventative advice in order to manage your risk. So that's one of the things. What this also means is that insurers now have to impute a huge amount of data, so we have to have data sharing protocols and open source tools which help us in order to extract information beyond submissions, beyond our loss runs, which is the claims that have happened on a particular company, to also information that we are gathering through alternate data sets. There might be not just information about your stock, but the social chatter. Social chatter about the company, social chatter about BP, social chatter about Nestle or any of these large giant corporations. So we require this data insights to be fed through to us, and therefore we need a rich environment of code tools which are able to help our underwriters and our middle office people in managing this multiplicity of data. And then I mentioned connected devices. IoT. We have many cases of industrial and marine IoT which are being used today. When I think when the recent Suez crisis happened, we had almost real-time information on what was happening on the supply, to our supply chain risk when the ship got stuck in the Suez Canal. So there is a live event information which is emerging because of industrial and marine IoTs. Then there is, of course, distributed ledger technology, which is blockchain. Blockchain, one of the very interesting cases that is happening is in the marketing and distribution, where you manage multiple counterparties, which we do in co-insurance deals, through this blockchain architecture. So that's super interesting for us because it's managing so much of inefficiency of a human being going out and getting a consensus around a particular deal. Finally, what we do, another interesting, very interesting technology or application of technology that insurance is seeing is parametric insurance. What parametric insurance does, it's like an index insurance. When a particular claim event happens, usually a claimant will come in and say, claim event has happened, and the loss adjuster will go and look at the extent of loss, and then you will pay up if all the conditions are met. Parametric uses certain sets of information which are from third party. So they're not influenced by client nor influenced by us. This third party validation data on weather patterns or any other information are modeled, and they trigger payment if certain conditions are met. So it's all completely remote from any of the two counterparties, and it pays up quite instantaneously. And we've seen application of it in flight delay products, but there are large-scale applications of it in agricultural insurance as well, where we are paying up for crop insurance very quickly. And this is really helpful in remote areas where you need the money very, very quickly in order to get back on your feet. And if a protracted process of loss adjuster coming is the way to get paid, that adds a lot of time. And so parametric is solving for this quite easily. So that's one of the areas that we see a huge amount of industry appetite and applications within commercial insurance. So what is the key takeaway that I want you to take back from this presentation is that, one, there is a need for building sophisticated and integrated digital infrastructure, which should underpin the entire of commercial lines value chain, not just the underwriting part, but claims management, also the functions which are supporting middle office, credit, all of these functions. There has to be an integrated architecture which supports all of these activities. And the industry has to move from huge amount of manual interactions that we seem to have from process to process to process into moving towards a more frictionless environment, because that not only helps our customers, it also helps us scale any operation and understand our environment better. Also, in terms of our interactions with our clients who are large corporates, there is a huge amount you can gain through automation. We've seen investment banks have a much stronger relationship because of technology support that they get in managing their large clients, when they're underwriting IPOs for them or any debt offering. Similar kind of interactions can be brought into the insurance industry as well, have not been done so because it's been so relationship driven, and everybody has thought that good relationship underpins all client interaction. It does, but good relationship is only enhanced if you are more informed. If you carry the information from 30 years ago of having been in the industry 30 years and not learning as the live information becomes available, then your interaction with the client may be personalized. She or he may think you're a great person, but he or she may not think you're a very useful person because you're not able to keep up to date with all the information that the client needs to manage their risk properly. And then there is an absolute need for having an ecosystem approach. We cannot operate as an island in this very complex industry. We cannot think that the intellect that resides within a single insurer is enough to manage the complex risks as they emerge. Look at cyber. You have ransomware attack. You have a huge amount of DOS attacks, denial of service attacks. Is it possible for a single insurer to hire many people in order to be able to manage such a risk? No, I do not believe so. I think it is very important that we work with ecosystems. I think it's very important that we work with open source tooling so that we are supported in our product development by outside world as well. And I think for any insurer or commercial insurer to be successful, we need to move with the times. So I'm happy to take any questions. Thank you.
Thank you, Parul. Are there any questions from the floor? I have a load here. One at the front. Could we get the microphone down? We'll just take one from the floor first, then I'm going to take some questions from the iPad of truth.
Thank you. At the beginning of your presentation, you referenced different levels of coverage for different markets, specifically England and Germany, looking at flood risks. I just wondered if those, if the higher level of coverage here had, in your opinion, been driven by technology and what the impact is in specific levels of coverage.
So what I was referring to was the remaining protection gap. In UK, so this is also the function of experience. UK, we experience floods very, very frequently. The level of flooding, which means that we have Flood-Re, which the UK government has sponsored. We have interactions on with the government and with industry bodies on the important topic of flood. In Germany, such a catastrophic event like floods is an impact which is being attributed directly to the increasing global warming. They haven't had such a severe event in many years, and that's why the level of devastation is so high. Probably, if this, for times to come, if this is to remain the case, then they will have to move to, they are on a higher vulnerability, and therefore they will have to move more towards how UK is behaving. I think it's, in my opinion, it's more the function of them increasingly having more severe events coming into that particular geography. Thank you.
Okay, thank you. I have a question relating to supply chain. We've just seen that Apple's share price has taken a hit because they can't get the semiconductors to get their iPhone made, so they've said they're going to have to reduce the amount of iPhones that they're producing next year. So are more companies at the moment having to take supply chain insurance, and what do those premiums look like? Because everywhere there's a supply chain problem.
Okay, so I will admit that I'm not an underwriter, so I will not be able to give you the underwriting part of the answer. What is happening in the industry and what we are seeing as insurer is with the supply chain issues, and this is very macro issue here, and this is financial economist and me jumping in. What's happening is regionalization of trade. So there's a lot of discussion when we are looking at supply chain is people are looking at China plus one. So that's a standard policies that many large companies are saying, okay, there is a clearly geopolitical situation emerging wherein higher exposure to China, with the emerging, they call it dual circulation model in China. Dual circulation model basically is an economic policy decision China has taken that they will continue to reduce their export dependence of their economy. So they will start growing more importance to the domestic consumption. It has an impact on how global supply chain procure from these areas. And because of the COVID pandemic as well, and you were sourced into a smaller area, the supply chain behaviors started changing, which means that increasingly, and Apple procures a lot in China, so they have to look at other sources where they can procure more. So there is a regionalization of supply chains, which is a big trend. What it does for the premia is that you impute all this information on what is the likelihood of a particular supply chain risk event happening, and then you price that into your model. I'm not being an underwriter, I cannot tell you what exactly has happened as we speak, but as an economist, this is what's driving it.
Okay, all right, fair enough. How do relationships in insurance evolve in a period of lockdown? Is digital transformation the opportunity, or is it a threat?
It's absolutely an opportunity, because however great at social relationships and higher EQ an individual who is meeting between, a broker who's meeting between various insurers could be, or your interaction with the broker itself, but it's limited to an individual. Digital transformation can help you scale the interaction, can create depth so that you are turbocharged, you become exponential as an underwriter, you become exponential as a broker. So it is definitely an opportunity. If we are in an industry which hasn't grown for 20 years, this may be a way to actually grow the size of the pie. Instead of it being a threat, I think it is a great growth opportunity.
Do you think that the insurance industry has been behind the curve when it comes to adoption of technology?
Coming from investment management and banking, yes, definitely. I mean, it's objectively speaking. I cannot say, no, we are great.
Okay, if anyone wants to argue that point, feel free. AI and machine learning is a hot topic we've heard in a few sessions already today and countless ones yesterday. Is this the most important technology for the insurance market moving forward?
Absolutely. In insurance, we like to call ourselves the original data company. And if you as a human being, your neural network can impute X number of various data points and drive a particular insight out of it. If the machine learning can help you do more, create feedback loops and service more, then it's in effect making you much more effective. You're still a human-led organization because the nature of risk is evolving, but your understanding of this nature of risk is becoming exponential as the ML models are using your decision-making and the data that it can ingest from outside to drive even further right level of insights for your clients and for you as a business as well.
Okay. Any more questions from the floor? Not at the moment. Okay, let me see if I've got one more here. Yeah, we'll take one more question. What are the risks associated with data sharing across insurance?
I mean, data sharing risks are very, very well established in the GDPR protocols. And also in certain lines of insurance, which Tanguy also referred to, like health insurance, there is the risks range from consumer privacy issues, which can be which data sharing can cause for you to breach. There's also how is the data that you're sharing utilizes that? Is there an agreement in terms of what has been agreed with the owner of the data? Then, of course, there's a question of ownership. So all these, they are very well established principle of risks in data sharing, which we can reference back to legislation, which are European legislation, and also from the high-level expert panel, which is talking about how AI should be utilized, the points of explainability, interpretability, freedom from discrimination, etc. Although these are not linked only to the sharing part, but once you share, you lose control over how it's being shared. And that means that there's certain parts of how the data is being utilized that becomes hard to control.
Okay. All right, I think that's all we've got time for now. So thank you, Parul.
Thank you very much for your time. Thank you, Scott.
Thank you, Parul.